What if I told you there was a way that you could pay your mortgage down in 10% of the time? You could have no house payment in 10% of the time that it would have otherwise taken you. Well, that's what I want to talk to you about today. First off, why should you even listen to me? My name is Brennan Wiersma. I'm an airline pilot, and I became obsessed with personal finance because I got into a whole bunch of student debt, and I'm actively working on paying that down. I studied the Series 65 study material. I plan on passing that test. I think I'm an expert in at least my own personal finances with regards to how to pay down debt, how to save, how to invest, what are the different retirement accounts, what are the next steps that you need to do in order to get yourself on track. I feel like I've got those down pretty good. I've read all the books, so I'm going to give my 2 cents. You can choose to listen to it or not. Anyways, the topic I want to talk about today is called velocity banking. And this is something I heard on a podcast and then talked with some of my mentors on. And it's a real thing that works, and it's not something that is traditionally advertised by banks, in my opinion, because there's not a real reason for them to do so. So the 30-year mortgage is essentially a product that a bank offers to make money, and it's amortized over 30 years. And what that means is the beginning portion, most of your payment is going to be going towards interest, because people sell their houses between, on average, like 5 and 10 years or something, somewhere in there. They sell their house before the 30 years is the idea. So the bank's got to get their money. They put all the interest in the beginning of the mortgage. As you make that same payment, it's a fixed amount. The payment goes more towards principal than it does for interest. Now, what that ends up doing is the person that owns the 30-year mortgage just pays up a whole bunch of interest, especially over the course of the 30 years. You're going to pay like double what the original amount was, or you're going to sell your house and then restart the clock, or you're going to refinance and just keep paying more interest. So that's the traditional way, and it works. It's a way to buy a house. In some cases, it's cheaper than renting. You get benefits of owning a home. So I'm not knocking that completely. I think there's a lot of reasons to get a 30-year fixed rate mortgage, or maybe even a 15-year. But there's another concept that I want to offer to you. It's called velocity banking. Now, there's a few ways to do this. The way that I want to talk about today is by using a first position home equity line of credit. So what is a home equity line of credit? If you own a house and you make payments on it, you own more of the house, the bank owns less of it, you're paying down the debt, the remaining balance is your equity, and the bank will offer you an option to use some of that equity and extend you a line of credit based on it. So if you don't pay them back, then they have the equity in your house that they can take from you in exchange. So that's how it works. Traditionally, that's called a second position lien. So first position is the 30-year mortgage or whatever you have there. The second position is the line of credit that they're issuing you, or that said bank is giving you based on the equity that you have. And there's ways to use this concept using that, but I'm talking about a different one. So let's say you bought a house for $1 million. 10 years go by, now it's worth $1 million, and you've been paying down the mortgage, and you only have a couple $100,000 left to pay back. Well, essentially what that means is you have about $800,000 in equity, and the bank still is owed about $200,000. What a bank will do, and it's not advertised because it really doesn't make a difference. I'm not sure they make any more money doing it this way, but they're not any less incentivized to have you do this, is instead of refinancing that home if you wanted to into another 30-year fixed rate mortgage on that $200,000, you could do a home equity line of credit in first position. So you're basically just refinancing into a different product, which would be the first position home equity line of credit. Now, you might be wondering, okay, get to the point, why would you do this at all? There's a few key reasons. With a traditional mortgage, your payment stays the same. Your payment never changes. It's fixed from the day you sign that contract that says you're going to pay $1,500 a month for the next 30 years. And then of that $1,500, a certain amount goes towards interest, a certain amount goes towards principal. Well, with a home equity line of credit, the interest is calculated every single day. So what that means is, let's say you have $200,000 and it's even at 6 or 7% interest, which is probably what it would be right now if you had a good credit score. I don't know the payment off the top of my head. Let's say it's, $1,000, call it $1,000. As you pay that down, you make a payment towards it, the principal balance is going to go down, and the next day, the interest is recalculated based off that new amount. So as you pay on that mortgage now, the payment you're making is going to be increasingly less. It's also not amortized over 30 years the way that a 30-year mortgage is, where the interest is all front-loaded. It's recalculated every single day. So more of that payment is going towards the principal amount, which is going to be allowing you two things. It allows you to pay down the amount faster. It allows your payment to be less, so decreasing your living expenses. You should keep paying as much as you can. And so it's lowering the balance, and it's also lowering the amount of interest that you pay. Now, there's a third component to this, and this is where the net term velocity banking comes in. Normally you deposit your money into a checking or a savings account, and then you would pay your bills from there, wherever it is. Well, this strategy, what it says to do is you now have a line of credit for $200,000. So as you pay this down, you still have that much credit that you can use. So this strategy says, instead of depositing your income into a checking account where it's at best giving you 4% interest, a checking account wouldn't do that. Maybe a high yield savings account, but a checking account, definitely not the case. You're going to be losing at least 3 to 4% a year interest, whatever that is. You're going to be losing that every month. Instead of doing that, put it into your home equity line of credit. So this is an account that you can literally spend from, like a checking account. It's just credit. It's like a credit card that's backed by your house. So, and this only works if your income is more than your expenses. This strategy. So you deposit your income into the line of credit, so the balance goes down. The interest is calculated on that new amount, and then you pay your bills or whatever it is from that account. The delta between what you're spending and what you're earning is how much you're now decreasing that balance, therefore decreasing the amount and decreasing the interest. So by using the home equity line of credit as a checking spending account, as long as your spending is less than your earning, all of that balance held against the amount is going to be helping you pay that down even quicker. So it's just it's forcing you to make extra payments by no extra effort, because your spending is less than, and the difference between those two is getting applied towards the line of credit. And over enough time, you're going to pay that off, and it's going to be accelerated. And from the studies and the examples I've seen, it's like 10 times quicker. Now the important thing to know is, if you are currently somebody that is spending above their means using credit cards, this is not the case for you, because likely what you're going to do is you're going to have access to a line of credit, and you're going to want to go on a vacation or buy the boat, and just like you've been doing, you're going to be spending more than you're making, and so you're going to be using that credit, and your debt's just going to increase and increase and increase. So it's a very dangerous thing. But I think for somebody that has been responsible for a long enough period of time, and you know who you are if you're listening to this, if you have credit cards and you're holding a balance, probably just skip this and go to the next one. But it's something to at least look into. There's people that teach this. I've heard a couple people talk about it, and this is my best breakdown of it. Obviously, go and do your own research and look into it yourself before you actually go out and get one of these things. But I think it is truly a way to decrease the amount of time that you would have a house payment. So let's say you have an emergency fund. Let's say you have 6 months living expenses saved up. If you were to just put that into your home equity line of credit, that's also going to be bringing the balance down, therefore decreasing the amount of interest that you're paying, and you still have access to that money because you have a line of credit. So you could use that line of credit as an emergency fund if you needed to, rather than, worst case scenario, having to, quit your job because you ran out of your emergency fund, and now, now you can't make ends meet because you don't have anything to pay the bills with. Let's say you have a home equity line of credit and you're only using that $200,000, but you have a line of credit for 90% of your home's value, which is, whatever that would be, $900,000. You have access to $900,000. You're only getting charged interest on the amount that you're using, which is the amount remaining on your mortgage. If you needed to, you have a line of credit that is in equity in your house that you could tap into to float yourself instead of having to take a job you don't want to or whatever. Like you could also tap into this as a way of covering expenses if you get stuck in a tight spot. So it's access to more capital basically. If you're paying 6% interest on this line of credit, and you can find an opportunity that's going to be making you 15% interest, whether that's even just lending your money out to other people to go do a house flip or whatever it is, there's a way to arbitrage that. That's basically no extra effort to you. So just food for thought. That's something I thought was really interesting, and I hope you got some value to it. If you are somebody watching this that wants to get on top of your finances a little bit better, I do have a free school community, and I offer one-on-one coaching inside. It's not going to be high-level tax strategy or anything like that, but I can tell you where to start if you're in credit card debt, help you build a budget. I have a free budget spreadsheet that I created that I use myself at least every week, if not every day, and basically hold your hand and walk you through, okay, where do I start? How do I even go about figuring this out, whether that's what do I pay down first? Where should I start investing? How do I set up my kids' retirement account? What's the best way to do it? Can I have access to the Trump account? What's a 529 plan? Should I get life insurance, whole life insurance versus term life insurance? Those are all questions that I've looked at myself as a dad and a husband. So if you're interested in that, I'll put the link in the description, and I'll see you in the next one.